G'day everyone and welcome back to this Hidden Gems webinar Friday series. This is the second last webinar for the year. Thank you all for your time. This week we're talking financial services, software as a service, cancer treatment and graphite mining. Now, not much to note in the markets other than plenty of turmoil at the Market Herald, our old nemesis. Let's watch out how that sideshow plays out over Christmas as the board tries to get rid of CEO Jag Sanger. Don't forget to ask questions of the companies presenting. Type them in the box provided. Try not to be anonymous. That way we can definitely reply back to you if we don't have time post the live event. Okay, we're going to make a start. First up, we have Sequoia Financial Group, ASX code SEQ, market cap of $70 million. If you don't know Sequoia, they also own our platforms, our research platforms, ShareCafe and also Finance News Network. We have with us the Executive Director and CEO, Garry Crole. The company is an integrated financial services business providing products and services to self-directed retail and wholesale clients and those of third-party professional service firms. Garry, thanks for your time. Over to you.
Thanks, Tim, for having me and welcome everyone and thank you for attending. I will start quickly and I've actually got quite a short presentation. I've tried to keep it quite simple today. My major purpose is to try and give the listeners an understanding of what we do, why we do it, and what sort of return on shareholders' equity we get as a result of doing it. I might just move to the disclaimer. I might stay on the disclaimer, which is quite unusual in these types of presentations because it's actually important in respect to what we do. This presentation clearly is of a general advice nature. But much of what Sequoia does is we're in the business of providing personal advice and advice to Australians. And Australians do not get enough advice. Only 10% of the Australian population is dealing with a financial advisor. And one of the major issues around that, one is cost. Some people don't see the value of seeking out a financial advisor, but more importantly, there is not enough financial advisors in the industry to support the needs of clients. Currently, there's only 16,000 financial planners in Australia looking to serve a working population of about 16 million. So about 1,000 per advisor head, where an advisor's capacity is more like 150 clients that they can look after properly. So I thought I might just touch on that. And secondly, as Tim pointed out, I'd like to disclose that we own this business as a part of the offering we provide to the financial advice community. I'll move to the next slide. So as I touched on just before, I'm going to talk about the services that we offer, which are quite broad. So in reality, what we're looking to do is we've got three groups of clients that we look to serve. That is financial planners, that is accountants, and that is the trustees of self-managed super funds. So very large markets. And then what we've looked to do is to try and look at what the type of services that community needs. I will then touch on who is our client, and our financials, where we're looking to head, and at the end, hopefully, most of the presentation, I'm quite happy to finish early because I see questions as the most important aspect of these types of presentations, and we're very open to questions, and hopefully we get a few. We'll move to what the services we offer are. Primarily, we provide services across 4 divisions: licensee service, professional services, equity markets, and direct investment. And we provide those services to those 3 groups of people that I'm talking about. So a financial planner, an accountant, and a self-managed superannuation trustee needs a whole range of services to get advice and try and improve their financial situation in a market that's confusing. As the 200 odd listeners would be today, I assume that you're listening today because you'd like to know more about your own personal financial affairs. And you seek a professional in some capacity to give you solutions and advice and interpretation of those financial affairs so you can make some sound decisions in respect to that. Our role and the services that we provide is to try and educate and provide those financial planners, accountants and self-managed super fund trustees those solutions. The licensee services, and much is talked about this area of our business. Some people think it's all we do. It is far from all we do. So we provide the license. And a number of people talk about, the number of advisors in the industry and how many advisors do you license. That is one of the businesses that we provide. So we provide license for about 300 odd financial planners under our license, but we touch around 1,500 advisors of the 16,000 out in the industry in some capacity. And that's whether they use one of our other services or we provide back office services to third-party licenses. We also provide general insurance broking services. So a financial planner, an accountant and a super trustee has general insurance broking needs. So we provide a solution to them. We're a member of the Steadfast group in respect to that, which is one of the biggest buying power groups in the country alongside Austbrokers. So it gives us really strong buying power, and our end client, as a result of having a relationship with a financial planner, accountant or a trustee that we provide a service to, gets real value because of that relationship. We also have a corporate function where we do IPOs and capital raisings. A few reasons for that, but again, the major reason is our end client being that accountant, financial planner or trustee. They're looking for opportunities that are not necessarily available to the general public, and they're looking to find advantage as a result of the personal relationship they have with our accountant. And that's the reason why we have a strong corporate department. The next area is professional services, and it's one of the fastest growing parts of our business. So the accountant, the financial planner, obviously look to provide the right corporate structure for their end client, and we provide the legal documentation to do that. So when you go and see an accountant, and the accountant or the financial planner in some cases sets up a company, trust or super fund, they use a business like one of the ones Sequoia owns. We touch around 2,000 accountancy practices in this area of our business, and we're setting up around 200 structures per day. That's a business that's increasing at a rate of about 20% per annum, and more accountants are coming to us because we've invested heavily in the technology side to make it really, really easy for an accountant or someone at an accountant's office to go and set up a company trust or a super fund and get the right type of trust and get the right type of super fund wording that's always up to date and allows their clients to feel safe and have the right structure for when they're making investments. Equity markets is a business that many people would know as Morrison's. That's a business within Sequoia. We're the number one options trader in the market. In respect to equity trading, we're seeing growth of around 30% per annum. We're winning business from our competitors, and we're doing about $2 billion of trades per month in that particular business. We got to a break-even point in the Morrison's clearing business about 12 to 18 months ago. And it really is a toll road type business. So once you get to the critical level, in our case was about 16,000 contract notes per month was break even. We're now up around 50,000 contract notes per month. So that business is growing quickly, and we think our offer to the accountant, the financial planner, and the self-directed investor who does lots of trading and wants high service is the number one in the market. We also have a specialist investment business. So from time to time, clients want to access bespoke type investments. We deal with the leading banks around the world. We come up with a thematic or an idea where a wholesale investor or a financial planner comes to us and said, look, I've got clients who have a need to try and find income, or I've have clients who want to invest in a thematic such as electric vehicles or something like that. We create a structure and offer an investment out through our network. And finally, the direct investment business is the business that you're listening to now. That's businesses like Financial News Network, ShareCafe. And the point of that business is really important, is because it's really an education point for financial planners, accountants, and the self-managed super fund trustees. It's also a research business, so we're really strong in providing research on hopefully every fund in the market through our Informed Investor website, which is www.informedinvestor.com.au. We're basically looking to interview all of the fund managers in the marketplace and provide information on all the funds, so a financial planner, accountant, and the end client can have independent information to make a choice about who they're investing their money with. I'll move to the next slide, Tim. So the businesses are wide. So, those 4 offerings, we have 20 businesses, all of them small, but all of them interacting with each other to provide that one common service, is to serve those 3 communities. Each one of them in their own right is profitable, and all are now beginning to talk to each other to provide cross-market opportunities to each other. On a sum of parts basis, I think the valuation of Sequoia is significantly undervalued. If you looked at those pieces, and hopefully no one does from a private equity point of view, but if they were to look at the sum of parts valuation, this business is clearly heavily undervalued. Move forward. As I touched on, a fraction. So what we think about as a board and with the management team is who is our end client, and how could we serve those in a manner to make their business better. And if we do that, we will generate a reasonable return on profit. So the headwind for everybody in our industry is the number of advisors serving the community. So the number of financial planners out there has reduced dramatically. A 40% reduction in advisor numbers since 2019. Looking to serve a community that has more need for advice now than it had in 2019. So the account balances of people in superannuation are growing. The population is aging and living longer, so they're having to work out what to do with their money. Inflation fears, global fears, all those sorts of things are creating tailwinds for advisors. Clients knocking on the door wanting advice, but the challenge is there's not enough advisors to serve that. So there's currently 15,800 advisors and 1,100 licenses at December 2022. We license 2% of that market and touch about 10% of that market in one of the services that we provide. One of the things we haven't talked about, and maybe I should talk about it, because people focus on how many advisors have you got and how you're going in that growth phase. Sequoia is the only license in the top 10 license which is led by AMP and Signia at the top. So the only license in the top 10 since January 22 that has not had a decline in the advisor numbers. So most of those other groups have had declines of 40 or 50. Sequoia is actually net positive since January 22, despite the number of actual advisors available to be licensed dropping dramatically. On the accountancy side, we're winning market share. There's 20,000 accountancy firms in Australia with about 200,000 accountants employed across Australia. We're touching more than 3,000 accountancy firms. So the opportunity to provide our service across that market is very broad, and they're the sort of things we'll do. There's 650,000 SMSFs in Australia, with 27% of the superannuation invested in the market. So a huge market and very, very important to us. I'll move to the next slide before I run out of time. Financial performance is obviously important. We have, 22 was a good year for us. We generated $14.7 million of operating cash flow before tax. We paid out 1.4 cents in dividend on a 4.2 cent dividend net profit after tax. So we're keeping 60% of the operating cash flow for growth, and growth is where we're heading. Move to the next one. The key, I might move past this so I get to questions. I said most important. Where we're looking to focus on the near-term future is organic growth is extremely important, but growth by acquisition is somewhat important. So licensee services and professional services, we're definitely out there looking for acquisition opportunities. In the professional services area, we're looking to buy businesses on 3 to 4 times earnings and just bolt them in. On the licensee services area of the business, that's much more difficult. You've got listed companies like Count, the Verger, Centrepoint Alliance trading at sort of 9 to 10 times earnings. We're not prepared to pay that type of price, but we may use our cash to acquire other businesses. The capital management strategy, we're happy to do buyback. We do want to increase our dividends over time. We have a $13 million franking credit balance, so we can pay dividends for fully franked dividends for quite some time, even if we weren't to make any future profit, but we obviously expect to. Next slide. The number of shares that we have on issue is 133,620,000. That was a week ago. It's actually down to 132 million now after continued buyback. At 54 cents, our market cap is $72 million. We have $12 million of cash, more than $12 million of cash on our balance sheet with no debt whatsoever. So we've got an enterprise value of $60 million and an EBITDA of 12 million. So the business is basically trading on 5 times cash. We want to build up the cash. We're aware that the sum of parts of our business is significantly higher than the current trading value. So we're open to potentially selling some parts of our business if we can get a more realistic valuation, and then potentially increase our dividend payout ratio. We're going to increase it this year from 33% of net profit after tax to 40, and then to 50. But we're fully aware that we should be using our franking credits in the near term, just in case the government changes. I'll finish there and I'll open up to Tim for some questions.
Thanks, Garry. Does look cheap on a sum of the parts perspective. And there's a question here, what's your takeover defence? What's the strategy there?
One of the takeover defences is the top 20 shareholders own 59% of the company. The management of the company owns 30%. So my past business, Interprac, for example, the shareholders that came into that business still own 35% of the company, and they've been there for 3 or 4 years. So 60-odd% of the company shareholders are there for the absolute long term and believe in the long-term vision of the company. So for someone to go and try and attack us, they would have to pay a very, very significant premium for us to move away from the vision that we see. We're all thinking long term. That's why we're low payout ratio, use cash to make further acquisitions and grow this business in the same way that some of the major companies in Australia built their financial services models. Generate cash to buy more businesses at lower multiples than these trade at. So we don't think we're vulnerable, even though the share price is currently, in our opinion, undervalued.
And Garry, there's a number of questions here. We've run out of time, but one more big question. And as I said, if you don't mind answering some of those questions online in regards to the buyback and things like that. Now, the financial advice business has been a tough one. Increased regulation, compliance, remediation costs. Why should an investor invest in a financial advice-based business?
I think an investor is a good person to have a think about it, because an investor actually understands the challenges of making decisions on which company to invest in. And they, if you have issues, for example, in a legal matter, you go to a lawyer. If you want an opinion from an expert that you can trust, you're likely to go to a financial planner, an accountant, a stockbroker, etc. And there's just not enough of them. So the demand, people always talk about demand and supply. The supply of financial advisors offering this type of services is low. The demand is absolutely ever increasing, and Sequoia is in the business of attracting, more and more of the parties who can give that type of service. So there's absolutely no reason why Sequoia, at some stage in its future, can't provide a service to 100% of the financial advice community in some capacity, whether it's just being, using, the media side, or whether it's using our broking side, or whether it's actually us being licensed. And there's absolutely no reason why we can't touch every one of those. And the buy demand side supply is absolutely in our favour.
Great, Garry. That's all we have time for. I'm sure we'll speak before the end of the day. Talk to you later.
Thank you, Tim.
Next up, we have Knosys, ASX code KNO, market cap of around $19 million. We have with us John Thompson, who's the Managing Director. Knosys is a global software as a service information technology company, offering a range of software solutions designed to boost productivity, collaboration, and information connectivity in the digital workplace. John, welcome back to the network. Over to you. Thank you.
Thanks very much, Tim, and welcome everyone to this webinar. If we could move to the next slide, that'd be great. Firstly, I'd like to start with a bit of an overview on Knosys. So Knosys is a software as a service company. By this, I mean we develop software applications, we then host them in the cloud, and fundamentally we charge our customers a subscription in order to access that application that we are hosting. Now, we run a portfolio of solutions, and they are very much directed towards connecting people and information. So from that, I mean that we have 3 solutions in our portfolio. One is a knowledge management, the other is a employee intranet, and the third is a library management solution. And I'll talk a little bit further about them deeper in the presentation. But I'd like, if we move to the next slide, thanks. I'd like to start off with really just an overview of the business from a financial point of view, because I know that's of keen interest to most investors. If we look at Knosys, its FY22 results, we had an operating revenue of 8.9 million. That's up 94% on the previous year. So we fundamentally doubled our operating revenue throughout FY22, which was quite an achievement given that part of that year was during COVID. Of that 8.9, 8.3 of that revenue is recurring revenue, and that grew by 120% compared to the previous year. And that's what you expect from a SaaS-based business such as ours. We've also on this chart showed what our annual recurring revenue looks like as of the end of October 22, and we're projecting that we're somewhere in the order of 9.6 million. So as you can see, we're continuing to grow our recurring revenue and obviously our operating revenue. In any SaaS business, it's very much based upon a very high gross margin, and we're currently averaging 87%. And we've managed to maintain that level for a number of years. In terms of our cash flow and our cash position, the business had a cash outflow of only 220,000 for the FY22 year, and we had an adjusted operating loss of 1.1 million. And I'd add that that 1.1 was particularly driven by our investment in additional sales and marketing and investments in some of our growth initiatives, which I'll talk to a little later on. On the left-hand side, you will see a representation of our recurring revenue over the lifetime of the business. And as you can see, we're achieving a compound annual growth of over 41%. And particularly the last couple of years, we've really started to gain traction and see a significant improvement in that. Now that chart also shows the contributions from each of our SaaS solutions, blue representing knowledge management, green representing employee intranet, and the purple representing our library management system. So I'd like to talk to you a little bit more about the solutions. Next slide, please. Just to give you a feel of what it is that we do. So the first solution is our knowledge management platform. Basically, this is a software that assists agents and employees who operate within call centers, contact centers, or service desks. Generally what it is, it provides the agent with the right answers to give to customers, or it steps an agent or an employee through a process. And this is all about maintaining consistency and governance within that particular business operations. Of recent times, we've seen the knowledge management platform be used as a single source of truth. And by that, I mean it fundamentally delivers answers, information, processes to a company's digital channels. They may have a chatbot that they've installed, or they have a web portal that they want their customers to come through. When they're searching, looking for material, in fact, what they're doing is being served up information from our KM platform. The second offering we have to the market in SaaS is employee intranet. Now, think of this as just a digital workstation that an employee opens up when they come into work, and all the information they need to do their job is presented to them. It links out to applications that they need day to day. It enables them to communicate, engage and interact with fellow employees. And so it's very much targeted at employees' productivity and well-being. The third offering we have is our library management solution. This is very much targeted at public libraries, specialty libraries, and some academic libraries. Now, this solution not only automates the internal processes within the library and the library business, but of recent times has focused more and more on digital assets, how we provide those assets to members, how we share information assets between a group of libraries so that we get every library doesn't have the same collection. Next slide, please. So what does that mean from our point of view? Now, Knosys is implementing a very detailed and specific SaaS vertical strategy. We're doing this because what we want to do is identify the verticals that have a true business critical need for that solution. And as you can see from this slide, we have 4 verticals that we operate within. And you'll notice that in the majority of cases, in that vertical, we have 1 or 2 of our solutions being sold into it. The one on the left, the first one, is our health and healthcare vertical. Now within that, the employee intranet, the knowledge management solution is sold, and we have customers like HealthScope and Health Direct as key customers in that segment. Banking financial services, that's where we started our business. Once again, the employee intranet and the knowledge management is used by those organisations to better service their customers and to look after the well-being of their employees. The third vertical is retail. In this space, it's very much about providing employees with information, latest specials, what's happening with products, communicating with your employee base that is very distributed. And the knowledge management side is all about managing customers who ring up and are making queries in terms of products, offerings, and things of that nature. And that's quite a growing vertical for us. And the fourth vertical is government. Now, this is our largest vertical. We sell library management to well over 100 council libraries, and we also sell the knowledge management platform into service organisations such as Service TAS, Service SA. These are organisations that are designed to provide a single entry point for people to query, ask questions, apply for over the internet via web applications. So all these solutions have very common principles, and that's one of the reasons they sit very well together. They are first intelligent search. How do we make it easy for people to find the right information first time? Governance, in terms of how an organisation publishes information and how it tracks the use of that information. Personalisation, really important these days. You only want to deliver the information that is required by that individual, be that individual an employee, or be that individual a customer. And the fourth one is security. Obviously, we spend a lot of time making sure that our solutions are very secure in the cloud to offer that assurance to our customers. And as we've said in multiple announcements, we operate a shared services model. By this, what I mean is that we have standardized our practices in terms of how we deliver a solution to a customer. And that goes from the commercial contracts, that goes from the project services, customer support, customer success. So across all these solutions, we have the one or various teams operating in the same way, and that provides efficiencies for us as an organisation. Next slide, please. So just to give you a view of our customers, we have very much a global customer base. Within this, you'll see very well-known brands within Australia. As such, we have 340 customers at the moment, and of that, 11% are enterprise customers. That is people with over 1,000 users of the particular solution, and we have 89% mid-market customers. On the left, you'll see the weighting on industry verticals. As you would expect, government is the largest vertical. Obviously, financial services is another large one, as is health, which is growing. And obviously, as we go forward, retail is another growth segment for us. Next slide, please. So in terms of Knosys, now Knosys has been around for approximately 6 years. During that time, we've expanded globally. We have 5 offices around the world. We have 380,000 users of our solutions, and we're active and operating in over 10 plus countries. I think it's also important to note that we have over 20% of our revenue is derived outside of Australia as we continue to expand our operations. Next slide, please. So in terms of where our future direction of Knosys, and particularly in this interesting times. We have three main areas that we're focused on in terms of growing. One is product and market fit. What we mean by this is we continue to invest within the three solutions to increase their value proposition, as this drives retention and also gives us a better chance and opportunity to bring more customers on board. We also focus on go-to-market, and we have invested, as I mentioned previously, last year significantly in sales and marketing, and we continue to do that in FY23, but very focused on health, retail, government and banking sectors. So we've narrowed our focus during FY23. We're also now looking at partner opportunities and looking at the potential for sales channels to expand and accelerate our new business line. And the third area is operational leverage. We are very focused on the bottom line for the business, and we are and have started programs to consolidate our operations, become more efficient. We started this by onshoring our Indian operation back to Australia. We've also now just started common software components that can be shared across the three solutions. And we're very much focused on allowing our customers to self-serve more. So that means that they can, through video assets, through learning systems, self-train, answer their own questions, which alleviates the need on us from a resource point of view. Next slide, please. So in terms of the FY23 outlook, we're targeting over 10% organic growth across our geographies. And as you saw at the first slide, we're currently sitting at about 16%. So we think over the year that we should be doing quite well. We've got a strong pipeline of large commercial contracts that we hope to execute upon during the second half of this financial year. And we are also very focused on our operational leverage and making sure that the rise in our revenues exceeds any cost base that we have at any particular time. And we're also expecting FY23 to once again be a very cash flow break-even position, if not positive. And finally, we've got favourable industry trends at the moment. The hybrid working model is very much paramount, particularly for our employee intranet and also our knowledge management as people come through contact centres and want more face-to-face activities. Next slide, thanks. This is really just a summary of where we are. We only have a small number of shares on issue, 216 million. Currently, we have an enterprise value of 15.4, and we do have some major shareholders, but we have a quite extensive retail holder. And as per Garry's comments, we think ourselves quite undervalued given our recurring revenue levels, and we certainly look forward to a re-rating of the stock as we go forward into FY23 and the following year. So I'll leave it at that for the moment, Tim. Any questions?
Thanks, John. Yeah, a couple of questions, quite a few actually. You recently announced Singtel, Optus and ANZ contract renewals. Are they spending more on an AR basis, or have you put through some price increases?
Yes, we've at the conclusion of the initial contracts, we also go through a negotiation process, and we have increased the value that we derive from those customers.
And sorry, there's another question here. Can you comment on your kind of acquisitions in terms of Green Orbit and Libero, whether there's been any negatives and what are the positives?
Yeah, look, certainly any acquisition, anyone who says acquisitions are easy probably have never done one or two as we did. And I think it's important for people to realise we did those acquisitions during COVID as such. So the upshot of it is Green Orbit, the acquisition has gone really well. We've increased the revenue from that business. We've added probably close to $1 million of additional ARR from the Green Orbit acquisition, which has been really good. We went through a very detailed program of customer engagement and also investment in the product that we continue to do. The Libero is obviously the later acquisition, and that too, we're going through a similar process of engaging with the customers, looking upsell in terms of increasing the pricing, but more importantly, we're very focused on changing any 12-month arrangements to multi-years. So we have a big focus on commercial renewals being 2, 3 or 5 years, because that really solidifies the customer base, helps with retention and gives us upside for the future.
And John, I was reading during the week, venture capital in the US is piling into employee monitoring and measuring productivity. Would that be a vertical you'd consider from an M&A perspective?
Look, it certainly is. A lot of our solutions, particularly if you look at knowledge management, the employee intranet, and even the library system, core to those solutions are, productivity, be it making the employer be able to handle more calls quicker, frontline banking officer to be able to do their work more efficiently, a library being able to manage more assets and help customers. So that is an area that is core to the value proposition of the solutions. And it's certainly an area we see with regards to analytics, how we provide more information to those businesses so they can manage their employees better. And that certainly is an area of interest for us.
It certainly is where the money is in a really troublesome market. So thanks, John. That's all we have time for. Enjoy your weekend. There's about 5 or 6 questions online, if you don't mind, if you've got time to answer them. Otherwise, I'll shoot them through over the weekend.
Thank you very much, Tim.
Thanks, John. Next up, we have BlackRock Mining, ASX code BKT, market cap of around 15 million. Is that right? Let me have a look at that. 152 million, beg your pardon. We have with us Steuart McIntyre, who's the General Manager, Corporate Development. The company develops the Mahenge graphite project in Tanzania, the world's 4th largest graphite resource. Steuart, thanks for your time. Over to you.
Thank you, Tim. Good afternoon, everybody. If we could just skip on to the next slide, please. Standard disclaimer, next slide, please. And just an overview of what we're going to talk about. Next slide, please. So who are we? We are a graphite developer in Tanzania. And where are we? How is the company differentiated from our peers? We have a very large project, 200 million tonnes. So it's tier 1 scale, 2nd largest reserve globally. It's also very competitive on the cost curve, which is very important for cyclicals. We're also the only graphite developer globally that is backed by a major anode producer. For us, that's POSCO, which is the largest ex-China anode producer. And POSCO are backing us in 4 ways. There are in 3 ways, pardon me. They're our major shareholder, holding 13% of the stock. They're our life of mine offtakes partner for the fines for module 1, which is about 32% of volume. And they're also providing a $10 million US prepayment to help fund development. Now, importantly, we have all of our key permits and agreements with the government in place in Tanzania, and we are in the process of securing debt for the project. We're targeting around 100 million US, and we're expecting indicative term sheets in hand, hopefully by Christmas, and we're hoping to convert those into credit-approved term sheets by, say, February next year. I guess the key point to highlight in this slide is our market cap's about 150 million. We've got 20 million in cash at the end of September, but the NPV of the project is a very substantial 2.1 billion if we can execute. So huge upside potential if we can execute here. And there are some very substantial graphite deficits predicted near term, which we'll touch on later in the slide deck. Next slide, please. So look, we have a very strong board and management team here. I won't go through all the details here. This is on our website. But look, a couple of the key details. Daniel Pantanay, in terms of execution of the project, he's been building mines for about 25 years. And actually, he used to work at CPC Engineering, which built Cyrus Balama graphite project in Mozambique. And he actually was seconded to Syra and worked on the project from front-end engineering design all the way through to commissioning. And so there were some lessons learned during that process, which are actually baked into the design of our project, because he's then been the study manager for Mahenge since 2018. That'll probably do on this slide. In the interest of time, let's go to the next slide. Look, key point on this slide is everybody knows a lot about the cathode materials in batteries. But for some reason, graphite's been overlooked, which is a bit strange because there's actually 7 to 10 times the volume of graphite in a lithium-ion battery as there is lithium. and it's in every single anode. So it doesn't matter about the different battery chemistries, graphite's in all of them. Next slide, please. There's actually two different types of graphite in batteries. Next slide, please. Thank you. There's actually two different types of graphite in batteries. There's synthetic graphite and natural graphite. Now, synthetic graphite is typically 2 to 3 times the cost of natural graphite, depending on depending on the oil price, amongst other things. It's also very energy intensive to make. And so what the car manufacturers are doing at the moment, they're getting the range and performance that customers are looking for at minimum cost, which means more natural graphite. Now, Tesla's already at 50-50 natural synthetic, and the expectation is that you're going to start to see more and more natural coming into batteries. The other driver, aside from cost, is performance. On this chart here, you can see the consensus view is that there's going to be more and more silicon coming into the anode over time to improve performance. Now, you can't intercalate silicon with synthetic graphite. So the more synthetic, the more silicon you want to put into the battery, the more natural graphite you're going to need. Now, you can see some numbers down here below the chart. The expectation, this is Benchmark Mineral Intelligence forecast, demand for natural graphite and lithium-ion batteries going from 182 to 1079 to 2805. That's a 15 times increase in the volume of demand over the 10 years from 2020 to 2030. So, I guess the key data point here is the natural graphite market is currently only 1.2 million tonnes. So we need to build a lot more graphite mines is the key takeaway. Next slide, please. So as I touched on, the market for natural graphite is only 1.2 million tonnes. Some very large deficits being forecast by Benchmark Mineral Intelligence. In fact, the deficits are expected to exceed the entire market within 6 or 7 years. Next slide, please. And what you can see, we put together the NPV for our project is using expert consensus pricing, which is the average of Benchmark Mineral Intelligence, Fast Markets, and Wood Mackenzie. And as you can see here, when you overlay it on the deficits, we've got a price increase out to about 2026, and then it actually rolls over, which in light of those deficits being forecast, actually looks pretty conservative to us. So next slide, please. These are the various the graphite prices for our 5 different products. I guess the key takeaway is in that top slide there, the first 2 products, the -195 and the +195, they can go into battery markets. You can see the percentage in the basket below. That's about 32 plus 9% is about 40% of our basket goes into battery markets, and the other 60% of our basket goes into much higher value end use products. The important point to note is if the fines market does rally and those fines prices do increase substantially, we can actually crush up our large flake and sell it into battery markets if it made sense to do that. And in the bottom chart here, you can see the orange line. That's about the spot price for our basket today, about $1,200 a tonne versus our all-in sustaining costs of about $518 a tonne. So the project would be viable and making 50% EBITDA margins if it was up and running today. We are not contingent on some escalating price deck. Next slide, please. And these are the project metrics. As we mentioned earlier on, very large potential upside here if we can execute. It's about $182 million to get the project off the ground. That's for the first module. We build it in 4 1 million tonne per annum modules. The first module is going to produce about 89,000 tonnes per annum of concentrate. The subsequent modules are funded from free cash flow. And as you can see, we've got a very, very long mine life, 26 years. That's with all 4 modules up and running. Next slide, please. This is a slide that shows where we sit on the cost curve versus other graphite mines globally. The key point to note here is because we have a lot more large flake, that's a higher value product, that is extremely beneficial to project economics. The other key advantage we have is we can produce higher purity concentrates than most of our peers. So instead of the industry standards about 95%, we can go 97, maybe even 98. And you get another $40 to $60 a tonne of revenue per 1% that you can increase those concentrate purities to. So this chart actually doesn't encapsulate those additional concentrate purities, the higher concentrate purities that we can generate, because some of our peers in Tanzania also have that benefit. So if we gave it to us, we would have to give it to everybody. So we've left that as upside for the moment. the point is we're in the first quartile on the cost curve globally. Next slide, please. John, our CEO, likes to talk about why Mahenge. The two key reasons are geology and geography. So on the geology, there's a few key advantages. We're able to produce high purity concentrates, as I said. We've got a lot of large flake graphite, higher value product. That gives us a really high revenue line. The geography gives us a low cost line. So there's three key advantages on the geography. Firstly, is we have access to low cost grid power at about 8 cents per kilowatt hour. And it's going to be predominantly hydro, which makes our graphite much cleaner and greener than our peers. We also have a train line going all the way to the port of Dar es Salaam. And the port of Dar es Salaam is one of the largest container ports on the east coast of Africa. It actually has 2 or 3 sailings a day back to China with empty containers on it. So that gives us very attractive backhaul rates back to China. Next slide, please. From an ESG perspective, we are very, we tick a lot of boxes on this front. And one of the key reasons is if you're targeting mining project finance from international project finance banks, you have to comply with the Equator Principles and the IFC performance standards. It's not optional. So look, we've done all of the work here. It's been independent expert reviewed, and as I say, that sort of links into our debt process. Next slide, please. This is a key slide. How is developing a graphite mine different to a copper mine or a gold mine? And it's these gold columns here. This is called qualification. When you're developing a graphite mine, you actually have to send large volumes of product to your potential customers before they'll sign a contract, and you need the contract to get the debt to build the project. So with POSCO, we had to send them a very large volume of product here. We've done around 610 tons of test work, which is an order of magnitude more than any of our peers. It took around 4 years and cost $25 million. So we are a long way ahead of most of our graphite developing peers on this particular point. And it's crucial if you want to access debt to fund the project. Next slide. So as I mentioned, the debts, we're aiming to have the debt in place in the next couple of months. We're targeting up to 100 million US of debt, and the construction period's around 20 months. So if we can kick off construction early next year, we should be up and running in the 4th quarter of next year. The first module costs $182 million, as I mentioned. The subsequent modules are a lot cheaper. The second one's 107. And so it's quite interesting. We've had a number of people chasing the battery material for the second module because POSCO only has the rights to the first module. Look, I'll probably jump to the next slide there. The only other key data point here is this US company, Urbix, we've signed an option agreement with these guys to potentially lock down the fines for the second module, contingent on them providing substantial funding to develop the project by February next year. So that's another key catalyst for the stock. Look, if you just want to jump forward a few key slides, yeah, skip the next one. Yeah, that'll do. I'll go over to questions. No, back one, please. Yeah, we'll go to questions now. We've got a few minutes left.
Thanks, Steuart. Thanks for being on time there. I think you're right with graphite relative to the market chasing lithium. There's a question here in regards to the political landscape in Tanzania, and also a question in relation to whether you have a special economic zone license from the Tanzanian government. So can you just paint the picture there inside Tanzania?
Yeah, so look, Tanzania is a fantastic country. So I'm a former mining analyst. I've been to a lot of places in Africa. I've been to Tanzania 3 times. I've never seen a gun. It's a very stable, safe jurisdiction, no conflict. 4 or 5 years ago, they did change the mining code and introduced a 16% free carry for the government. So that caused a bit of angst back then. But ever since then, every incremental change has been positive. So the analogy that I draw is not dissimilar to when Australia introduced the mining super profits tax. It caused some angst for a while, and then the politicians subsequently unwound most of the constraints. It's exactly the same. Tanzania is a jurisdiction it seems to be improving steadily every day. So yeah, we're pretty comfortable with the jurisdiction. In terms of all the agreements, we signed our agreement with the government in December last year, which spells out exactly how their 16% free carry works. So all of that stuff's in the rear vision mirror for us.
And can you give us a little bit more colour? You did touch on it in terms of the physical qualities of the graphite.
Yeah, so look, when I was a sell-side analyst, I had a couple of graphite players come in and present to me and say, oh, our graphite deposit is different, and it just so happens to have exactly what customers want. And I sat there and scratched my head and thought, how am I actually going to know if that's true or not? And I decided the only way to know was customer validation. So I actually joined BlackRock around a year ago after 15 years on the sell side, mainly because I think BlackRock has all the credentials to become the Pilbara Minerals of the graphite space. And so I've been here for more than a year, staring at one company only and one commodity only, and I've seen nothing to change my view on that.
That's a good support there. Now, what percentage of your resource is or would be suitable for EV batteries in particular?
It's about 40% of the product at current prices, bearing in mind that if the fines price is currently around sort of $750 US a ton, if the fines price doubled hypothetically, then we could basically crush up the entire ore body in essence and sell it all into the fines market. It's about at the moment our largest flake sells for around $2,000 a ton. It'd make no sense to crush that up and sell it into the battery market. But if the fines price rallies, then we could crush it all up.
A couple of questions here. Can you give us some more details around Urbex, their customers, and why the option that's been signed what that means for the company?
Yeah, so what the option's all about is Urbex wants the fines for Module 2, and they want us to bring forward the construction of Module 2. We obviously want to build it in one module at a time to minimise dilution and maximise value per share. So we said to Urbex, well, we'd be potentially interested if you could potentially stump up a big chunk of funding support, and the figure is in the order of about 50 million US. And so look, they're in detailed discussions with a lot of US OEMs and car manufacturers. Those discussions we hear are actually going pretty well. So look, stay tuned, keep your eye out for a big US battery manufacturer or OEM investing in Urbex, because we're hopeful that same entity investing in Urbex may invest in us.
Understood. And can you provide a little bit more details around the debt funding, around the amount you're seeking and how you would address any potential shortfall?
So yeah, look, we are seeking around 100 million US. And at this stage, there's a number of options to fund the balance. Obviously, the vanilla option is to raise equity. We're hopeful that POSCO will support that equity raising when the time comes, and obviously discussions are underway on that front. And interestingly, POSCO has some very aggressive growth plans. So they're planning to grow their anode business to 320,000 tonnes per annum by 2030. And if you do the numbers, that means they're going to need about 420,000 tonnes per annum of graphite concentrate. They've only secured 30,000 tonnes through us. That's Module 1. So we think they need Module 2, Module 3, Module 4. And look, we're in detailed discussions with them on that front. So we'll see what that gets to.
Steuart, that's all we have time for. There's a number of questions online. If you've got 5 minutes just to answer those,
Sure.
It'd be much appreciated.
Would be happy to. Thanks, Tim.
Thanks, Steuart. Next up, we have Clarity Pharmaceuticals, ASX code CU6, market cap around $252 million. We have with us Dr. Alan Taylor, he's the executive chairman. Clarity's mission is to develop next generation radiopharmaceutical products that improve treatment outcomes for children and adults with cancer. Over to you. Thank you, Alan.
Thanks, Tim. And thanks, obviously, the opportunity to share the story. Quite an exciting story, an Australian story of Clarity Pharmaceuticals. We'll just click forward 2 slides, just past the disclaimer and onto the main slide. It's changing a little bit of a topic of what the previous presentations were about. In simple terms, we're in cancer, and we're all about better treating children and adults with cancer. There's been decades and decades of great Australian science in developing our technology, so there is a lot of complexity to the story. But today, I'm going to try and simplify that, and certainly in the 10 minutes to broaden really the knowledge base of what Clarity is about. Because what we have at Clarity, we listed in August last year. We undertook the largest IPO of a life sciences company ever on the ASX, raising $92 million. We've got lots of money in the bank, but we have a shareholder base which is skewed towards strategic, institutional, and the top 10 shareholders own 50% of the company because of really the exciting space we're in. And really today is about simplifying that story and so people can start to understand. But really, If you hear about Clarity at all, we are a radiopharmaceutical company, and I'll go into the little bit of the nature of what that means shortly. But we're built around proprietary technology. We have some 20 patent families today. We're a global leader in what we call targeted copper theranostics. If you hear about Clarity, we're all about 2 isotopes of copper and how we utilize those to better treat cancer. And really why we're doing this is because of the significant supply benefits, environmental benefits, and really the focus on better treating these patients as this rather small niche area of radiopharmaceuticals moves into what is a massive oncology market. Can we move to the next slide? I just want to reflect on that a little bit. And look, I'm sure all the listeners here know cancer or have had someone in their family being treated for cancer. We can do it better, and there's a lot of new technologies, including what we're doing today, looking to grow that industry. We're in the area of targeted therapies, which has a large growth curve, but in particularly, there's a broad market of oncology, which, because we've really poorly treated oncology for a very long time, but these new technologies, new age technologies are really starting to take off, like immuno-oncology in our area. So not only is oncology looking to grow significantly, but importantly, you'll see down the bottom there, in our area, in radiopharmaceuticals, diagnostics are looking to expand quite significantly off the back of the PET agents I'm about to discuss with you. But also on the therapy area, you'll realize here that the therapy side of radiopharmaceuticals is relatively new, with really only 2 products in the market today, which fit really in our technology space. As we look to grow this quite significantly over the next 10 years, we need to actually build out our radiopharmaceutical capability, and that's where Clarity fits. We go to the next slide. So the reason why radiopharmaceuticals have become flavour of the month is really driven off the positive reimbursement and the recent assets to market. Just recently, Polarify, which is a diagnostic asset. I know that's quite surprising with a Q3 result of $144 million in revenues for a company called Lantheus, and they're now capitalized off the back of that of $4 billion. This is in prostate cancer, this diagnostic, but really growing this on the back of really good efficacy data and new technologies in the market. But then also on the therapies like Pluvicto. When you're looking at $250,000 for the treatment over 6 doses, there's obviously a substantial need for these types of technology, and despite the issues in the rollout and the supply chain, which once again I'll reflect on shortly, still got to in Q3 with recent approval, US $80 million. I want to touch on 3 key companies here and 2 strategics who are really driving the space. Novartis have undertaken 2 significant transactions in recent years, Endocyte for that Pluvicto asset, and then AAA. There was $6 billion of transactions on those, and Endocyte was really on the back of phase 2 data moving into phase 3. And then Bayer acquired Algeta, and Algeta is of significance here because half of our board and a lot of our team is out of Algeta / Bayer. And that was also acquired. It's in the prostate cancer space, which really supports our prostate cancer focus within our company, and was acquired for over $2 billion back in 2013. If we move to the next slide. So although I'm talking about our industry, about how exciting it is and niche and the opportunity, really it's driven by, at the moment, a rather cottage industry. A lot of the inputs, a lot of the isotopes are supplied off aging nuclear reactors. A lot of those are in Europe. There's been manufacturing outages, and they exist today. And a simple search of Google will find a lot of those. And there's complex supply chains when you're looking to supply what is the largest market in the world, which is the US market. And at the moment, there's a real inability for the big pharmas to control their entire supply chain. And this is with time-sensitive products which have short half-lives to be able to do that. So all of that is currently trying to drive out or supply what is the growth of this market in the massive oncology area. And this has caused a couple of, obviously, some significant issues, but the main is that the people who are treating, the oncologists who are treating patients, are starting to lose confidence with the products. And we can't have that in radiopharmaceuticals. We need to deliver products on time and obviously consistently, and that's where Clarity fits in. If we go to the next slide. So as I touched on in the beginning, we're focused really on two isotopes of copper, and that is copper 64 for imaging. And a lot of you may know what PET imaging is. And the predominant use of that is through FDG, a label glucose, to try and determine where you have your tumours. But where copper 64 is a little bit different is that we're obviously fitting on the targeting moieties themselves, and I'll go into that a little bit more detailed. And it's produced on cyclotrons instead of short half-life isotopes that have half-lives of about an hour or 2 hours, which is dominating the market, including that Polarify asset is a 2-hour half-life isotope. We're 12.7 hours. We can centrally manufacture off a single cyclotron and broadly distribute throughout, large markets like the US, and we also do that in Australia from Adelaide itself for our clinical trials on the coast. And that provides us a lot of flexibility. Instead of having to image patients in 1 hour, we have the flexibility over 1 to 24 hours, or even we've imaged out to 72 hours in one of our trials. And really, we're delivering here, and there's a level of complexity here. A lot of the short-lived isotopes require generators close to the patients, and we don't require any of that. We'll be providing ready-to-use GMP products for delivered to sites, injected into the patient, and then imaged. But where we really differentiate ourselves is this perfect pairing of copper, where we can then utilize copper 67 as a therapy agent. It's almost identical to the latest isotope, which is taking the world in that, and particularly in that Pluvicto asset. It's almost identical to that in every way except for the half-life, and our half-life is more optimal for the peptides that we use. So we target, hit, treat, and excrete. Commercially available rotatrons provide ample commercial supply of those, and those rotatrons are the size of a cyclotron. They fit into a room. They're not the size of a nuclear reactor. So we're drifting completely away from this reactor-based isotope supply to have it within country, within the US, the largest market first, and then driving and have the ability to control that entire supply chain, which is a real differentiator once again in commercializing this perfect pairing. And this delivers then a few things. We have obviously the supply chain benefits there, but also, and it's touched on by a number of the previous, certainly the previous speaker, the environmental considerations. When we talk ESG, we're moving away from reactor and long-lived waste from other, which you need for the production of other isotopes, to very simple manufacturing processes, very clean manufacturing for copper 64 on cyclotrons, copper 67 on rotatrons. And so as we grow from what is a very small industry into a very large one, this will continue to be an increasing focus for pharmaceutical companies, particularly the big pharma companies that are already across it in other areas. Next slide. So I want to touch on what our technology is, just to share it with the listeners, obviously the viewers, is where we're, and you're probably used to taking medicines and they're small molecules and they go everywhere in the body. And then you have products like chemotherapy, which is rather toxic to myriad tissues. And this is why you lose your hair. Not the reason why I lost my hair, but certainly a reason why chemo patients lose their hair is because it's toxic to a number of the tissues. What we are is very different. We're targeted therapies. So we need to target the therapies to the tumor itself. And that's where we have a thing called a targeting molecule, which specifically attaches to a cage. And the cage is the secret sauce. So back many decades ago, as I said, there was a great scientist out of ANU, Professor Alan Sargison, who said, we can hold these other metals, but we can't hold copper. And we need a chelator that holds copper because of this perfect pairing. So he made one. And that got into the hands of Professor Paul Donnelly at the University of Melbourne, who made it easy to use, highly stable, and importantly, bifunctional, that allows us to attach any one of small molecules or anything up to large antibodies or anything in between, so we can specifically target cancers and not have it target other healthy tissues and then excreted through the body. And that is really what our technology is. And given we're a platform technology, it gives us the opportunity to commercialize myriad assets. And this is where we are today, commercializing those. Next slide, please. And the one after. And so there's a fair bit of detail here, but this is where I want to reflect on what is really core fundamental platform technology is now rolled out into, in particularly, 3 core product areas, which are getting into later stage development. Next year, we'll be in phase 3 clinical trials for our diagnostics in prostate cancer. That market, just in diagnostics, is looking to get to blockbuster revenues, which is north of $1 billion shortly. And I mentioned that Pylarify asset earlier with the short half-life. We'll be looking to run those phase 3s as early as next year. But we have a number of products in development. I'll reflect on those, the ones that are in clinical development now. And firstly, on the next slide, we're in prostate cancer as a key area for our company. We have the experience in prostate cancer, given the Algeta number of Algeta and Bayer people within our organisation, and we have what we've done is optimised this BIS PSMA product to be what we think is a leader in our space. And we have a number of trials going on there. On the therapy side, we're in a dose escalation, dose expansion trial in the US under IND. For those who know, I won't go into that now, but we have the regulatory approval to run that trial, and it is running as we speak. And then, because of this large market opportunity in diagnostics, we're running 2 separate diagnostic studies. Propeller, which is in pre-prostatectomy patients, and then Cobra, which is in biochemical recurrence, or when you've had that treatment of your prostate removed and you have some rising PSA levels for those. We're running that trial as well. And they're the 2 areas that the FDA wish us to go into, and really that is a large market opportunity for us. Those trials recruited very well. The Cobra trials recruiting very quickly. And we'll have another update on that very shortly, and they'll move into phase 3 clinical trials. Next slide, please. Bombesin is another exciting product for us. It is also going into prostate cancer, but we're actually focusing on this niche area of around about anywhere between 10, 20, 25% of patients don't have that PSMA target, and Bombesin is able to target that market. We ran originally a trial at St. Vincent's Hospital in breast cancer, but the urologist started wanting to use Bombesin in their prostate cancer patients because they couldn't detect any disease with the currently available imaging modalities, and then were able to, in a small number of patients originally, 4 patients were able to suddenly find the tumours and then treat the tumours. So we've already changed treatment outcomes for those patients at St. Vincent's Hospital. We've now rolled that in, because of the strong demand at St. Vincent's Hospital, into an investigator-initiated trial, which is really to service the large amount of patients that we have here in Sydney, and then also in a phase 2 clinical trial diagnostic in the US, which is currently running and recruiting at this point in time. And the next slide, I'll just touch on this, which is Sartate, which is the next product in our pipeline, but certainly much further progressed as far as the opportunity. We're in a phase 1/2 clinical trial in neuroblastoma, one of the nastiest killer of kids under 5. It is the nastiest. And so we've moved up the cohorts. We're in cohort 3 in a dose escalation and do a dose expansion. And we have orphan drug designation, but also the rare pediatric disease designations for the diagnostic and the therapy, which provide us opportunity to get the vouchers, which trade for about $110 million US. Next slide, please. This is just, and I'll leave this for everyone to view, what we do at Clarity. We like to tell you what we're going to do, then we go and do it, and then we come back and told you what we did. and then we like to tell you again what we're going to do. And as you see here, we've already ticked some of the boxes here of this year and moving into next year, looking to really further progress our clinical programs, really with that ultimate goal of better treating children and adults with cancer. Move to the next slide, and I think that's it.
Thank you, Alan. Very comprehensive. We've got a number of questions here. Now, you floated in August 2021, and I think you said you raised $90 million, which is an incredible achievement, given what's happened to the biotech industry over the last 12 months in particular, but your share price is rock solid. Where did you get that support from in terms of who's the client base or the investor base? I think I saw the Australian government's a small shareholder. Is that correct?
So the Australian government is obviously the shareholder and only owner of ANSTO, the Australian Nuclear Science and Technology Organisation. That organisation is a shareholder of us through some original technology that came in and then invested over time within our company, knowing obviously the benefits of radiopharmaceuticals. We also have the University of Melbourne, obviously where the technology came from, who also invested in our company. Quite a unique position for obviously a university, but they've seen obviously the benefits of that and knew the benefits of what we're looking to achieve. And they've been not only a great shareholder, but they've obviously a great collaborator in moving the IP into the company and the like. But we have strategic investors. Genesis Care have a significant position in us, who's the major provider of private cancer services in Australia, and they made a massive acquisition in the US of 21st Century Oncology. They see how the US being the predominant market, a lot of cancer patients are treated actually in the community setting, not like Australia where it's more in the, you'd go to St. Vincent's Hospital or a big teaching hospital, potentially you get your cancer treated. In the US, 80% is treated in these community centres, and they're one of those groups. And this is where we differentiate ourselves to get products to those patients. And then we have a really good institutional following. As I said, there's a fairly large ownership internally. When you put shares and options in place, I think our team own up around 30% of the company. And as I said, it's rather consolidated with a strategic institutional team, and then obviously high net worth will follow the story for a long time.
I mean, we often see biotechs are either well supported by institutions or well supported by retail. They don't seem to merge. So for retail investors, and it is a complicated space, what are some of the key points they should know about Clarity? Yeah,
and it's probably my fault. I blame myself. So we have a complex story. I'm PhD educated, and when you speak to a fund or a strategic, they usually have a PhD in the room. So we haven't done a lot of any marketing to retail. The retail book sold out within a very small amount of time when we did the IPO. We had Jefferies and Bell Potter front a book there, and obviously Jefferies helped out there. There was a very strong demand, but only a small allocation for retail. So, and we haven't made any efforts to get to a broader retail audience. But the key factors for us are, we're in this hot space, and there's other companies in our space, small number of companies in radiopharmaceuticals, and it's a rather niche area. What the opportunity is, if you look at companies like Lantheus, who have grown fairly significantly in recent years with a small number of products and one in the market in particular now $4 billion US. There's a very strong focus now on obviously that diagnostic market as well as therapy. But what's key to us and what differentiates us from others is that we're later stage in our development. And there is a strong focus now. I showed you two strategics who are in the space and will continue to making acquisitions there, but there's a large number of strategics now of taking notice and who want positions in the space where we fit. We're clearly differentiated away from the other isotopes that have supply issues to be the main player in copper theranostics. And that will continue to grow as we bring products to market. But then also we start combination therapies with some of those assets that Big Pharma have, including immuno-oncology assets, where there's good opportunity to work together.
And in terms of working together, you seem to have a portfolio of products, if you like, or therapies. Is the plan to kind of license and partner with Big Pharma to move forward?
Yeah, good question. So we're definitely not a one-trick pony. and we've driven that platform of products which are in really nice niche areas. Where we differentiate, as I said before, it's this supply chain and being the major player in copper. So we're not necessarily looking, and this may change, but we're not looking necessarily to license one tech or one product. We may work with manufacturers and the like, but really this is a big play where we continue, we could roll out 20, 30, 40, 50 products if we're under a big pharma batter, which would actually work and grow out and expand into this market. So that's where we're looking to play more from that corporate perspective rather than maybe a single asset or partnering opportunities. And that's where we're seeing, obviously this is a very interesting space to big pharma. I'm not speaking out of school here, but that's where there's lots of interest in companies like ours.
And I suppose without those partnerships, if you like, funding is always the issue with biotech. What's that pathway look like moving forward?
So we've had a good capital market strategy already. We did a pre-IPO round of 25 and then an IPO of 92. We still have, around about $90 million in the bank, 84 currently, and then 6 coming in from R&D tax imminently. So we've got funding out to 24, 25. So we're in a really strong funding position. There might be some other things that we do, which actually bolsters that funding position, but certainly to get, and this is probably where we've been able to overcome what, as you mentioned before, probably the worst biotech market in the history of global markets. But it's not driven by the fundamentals. Pharmaceutical companies have more money than they've ever had, and are more aggressive on acquisitions than they've ever been. So we have the opportunity to ride that out and bring products to market in that time. There's a lot of, as you saw just this year, moving into next year, there's a lot of catalysts for us, and we'll continue to build out that story. So we don't have to worry about money today, but it's always front of mind. Obviously, from a person like me who's spent decades in the capital markets, it's always front of mind, and to see how we can obviously leverage that or drive that out further.
Thanks, Alan. You're certainly in a strong position relative to the rest of the industry out there. So congratulations. We'll follow up in the new year.
Great. Thanks, Tim. Thanks so much.
Thanks, everyone, for your time. Thanks for your Friday time pre-Christmas. We've got one more webinar next week. We'll see you then.